Well, I've been trading the Australian stock market for 10 years now, and I have to say that this is the most resilient XJO I've ever seen. Hi there everyone, welcome to the Trader Circle Weekly Market Update. Today is Tuesday, the 10th of September 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and it doesn't consider your personal financial circumstances. You have to decide whether it's appropriate for you. So I guess the big news over the past, really month, has been whether or not we're going to see a soft or a hard landing. So we saw some strong selling at the end of July, start of August, with the US jobs report at that time, and that was sort of exacerbated by a Japanese rate rise as well. Now we've actually seen a bit of additional selling over the past week with the US jobs report for the month of August. That came in lower than expected. There were fewer jobs created than expected, and it basically kindled this discussion about whether the rate cuts are going to come too late, whether they should be accelerated, whether we're going to see a recession in the US. As a result, we saw 4 days of strong selling last week in a row consecutively. US S&P 500 fell over 4%. They retreated from roughly their all-time highs and pushed back towards levels from about a fortnight ago, 3 weeks ago. It's not surprising really, because historically it's very difficult to get inflation under control without the economy going into recession. Some people might say it's actually impossible. There are times in the past where it's appeared, and when I say in the past, I'm talking about prior to the turn of the millennia, in the 90s and the 80s, and perhaps before that as well. There are times in the past where it's appeared that inflation is under control, and then the rate cuts happen, and then inflation reaccelerates. Realistically, the only times where they haven't had that reacceleration, it's usually ended in a recession or an economic downturn. Now, this time around, the market all this year has been convinced that inflation is going to be under control, and yet we're not going to see the economic recession. I think they're waking up to the fact, or at least with the past month or so of movements in the US, waking up to the fact that that's perhaps a little unlikely, or it's going to be very difficult to achieve. So we saw the jobs report, fewer jobs than expected. No doubt at the revision, when the revision comes out, it's probably going to be revised lower again. And we really start to ponder now whether we will see an economic downturn or a recession in the US. If that is the case, shares look extremely expensive. Even if it isn't the case, they look expensive. But if they do have a recession, we're going to see all those earnings forecasts downgraded. And if those earnings forecasts are downgraded, all these rosy forward outlooks for all these businesses, these businesses are currently trading on the absolute maximum rosy blue sky forecast, we're going to see those forecasts reduced, and these prices will come down further. Now, for the Australian market, we've largely ignored all of that. We saw the strong selling in the US. Our market barely budged. We had 1 day of strong selling, and then the second day where we were opening 100 points lower, we actually retraced it all during the day. It's really hard to come up with a reason as to why we did that. Company earnings are 5% lower this year than last year, 5 to 7% lower, I should say. Market dividends are 5% lower this year. Iron ore's quite a bit lower. We'll touch on that in a moment. The Australian economy is also teetering on the edge of recession, only held up by strong population growth. And we're actually we are a lot further away from our own rate cuts than they are in the US. So the resilience is very odd. But regardless, it is there, and the technicals have pointed perhaps to further bullishness. So looking forwards, we've got some pretty big events over the next fortnight. Tomorrow night, we've got US inflation data. We've chosen gold here, or at least my colleague Connor has, perhaps because we need to see a Goldilocks read at the CPI, the inflation reading. We don't want to see CPI be too strong. That's going to reduce the case for further rate cuts in the US. Obviously, the market doesn't want to see higher inflation. That's going to basically cause people worries about stagflation with other economic data weakening. However, if the CPI is too weak and comes in much lower than expected, again, that's going to point to an accelerated economic downturn and perhaps the Fed waiting too late to start cutting interest rates. So we want a Goldilocks reading. We want inflation to keep coming down, but not too quickly. And so it'll be interesting to see what the market response to that is. That's going to be on Wednesday night, Australian time. The following week, we've got the Federal Reserve meeting for September. And this is where the Fed is almost guaranteed. In fact, I would say guaranteed to cut interest rates. Many in the market are talking about a 0.5% cut. I think that'd be extremely silly. I think they'll go for the 0.25% cut and see how that plays out, see what happens from there. As I've mentioned before, in other certain rate cutting cycles where they've thought inflation was being dealt with and they've started cutting very rapidly, we've seen a re-emergence of inflation. And if that's the case, it becomes very difficult to get a hold of it again. You can go through many years of pain again. So I would suggest that the Fed will start with the 0.25% and go a little bit slower. Finally, I wanted to touch on iron ore this week. Iron ore's been extremely weak. It's fallen for pretty much the last sort of 9 months, really, or 8 months. It's not looked positive at all. Chinese economy has not looked great. We've seen a downturn in their property sector, their construction sector. We've seen build-ups of their iron ore stockpiles. We've seen build-ups of their steel stockpiles. We've seen, huge amounts of Chinese steel exports because there's no market for it at home. And we've seen steel prices coming down. So no surprise that the iron ore price has been weak, and it doesn't look like turning around anytime soon. In fact, over the last couple of days, we actually hit a 2-year low for the price of iron ore. I'm showing you this chart. This is a chart of iron ore futures at the Dalian Commodities Exchange. And it just will highlight that in China, green bars are selling days. Green bars are down days where the price falls. And so the green bars that you see on our chart here are actually where the price has moved lower. So iron ore keeps trending lower. It may have set a lower trough. Maybe we'll see a lower peak or a peak in the coming week or two. But overall, not looking great for iron ore. And so, that's been putting pressure on the iron ore miners. They've also paid out dividends, Rio and Fortescue have. BHP will pay it out on Thursday, and that's also kept their share prices fairly low. So with the iron ore price moving lower, our 3 largest miners, they make up 20% roughly of our index. With them all moving lower, it's incredible to see how resilient our market has been. And so if we have a look at the chart of the XJO, our markets index, it's quite surprising to me that we are pretty much back at our all-time high, just over 1% away from that level, if the chart will load. So we can see that we came down to potentially some support around 79.20. It was previously an all-time high, roughly. We held that level over the past 4 sessions. We've bounced off that level, and today we showed something of a bullish sign, although we were unable to hold our highs. And if we are to rise further, we're looking at 8100 as the resistance level to the upside. Like I said, it's been incredible, the resilience of our market in the face of iron ore selling and also in the face of selling in overseas markets. The only thing that's keeping us up is the incredibly expensive Australian banking sector. And yes, it has done some heavy lifting and it has kept drifting higher, but you really have to start to question just how much further it can go. Bank earnings are declining. The bank dividend yields are well below Australian government bond levels. We've seen changes to the hybrid market. That may have an impact on the banking space. And as I mentioned before, the Australian economy is teetering on the edge of recession. So whether or not we can go too much higher with iron ore lower and the banks already overpriced, I'm not too sure. So let's have a quick look at the US charts, if they'll load again. We can see they basically came up to their all-time high level over the past fortnight or so. That's roughly 5650 index points, let's say, and they stalled at that level. Since then, they've come off a fair bit, and that's on the back of the fewer than expected jobs created in the month of August. So with that being the case, their market started to head back down, and we're looking at a bit of support, probably around 5400. They held that overnight, and if they break that, we're likely to see further selling. I'll just draw in a line there. So 5400, if that breaks, we're looking at a move back towards 5250. However, if they can rebound from here and break above, the short-term downtrend line and the 50-day moving average, then we're looking for a move back towards the all-time high. I talked about the CPI tomorrow night and the Fed meeting next week. Those two key events will be very critical in determining whether we see, the next move being higher or lower. I've mentioned it many times. I believe that the point at which the Federal Reserve pivots towards rate cuts, I suspect we're going to see the end of the global uptrend that we've seen in shares. It might not happen immediately. It might take a month or two, but I think that's, for me, probably most likely going to be the turning point. So I will wrap it up there. Hopefully you guys enjoyed it. If you did, click like, click subscribe, give us some love in the comment section, and we'll see you next time.